a new IT person came in, and it looks like Kappa IQ works in the FSC on every machine. You don't even need your own login. You just log in with your UTSA and click on Excel. And so I tried 5 different machines. So you need to get Bloomberg and Kappa IQ on your resume. Now's a good time to do it because we have videos to show you how to use it. Some of you have classes where we use it. I have spreadsheets that work with Bloomberg and with Kappa IQ. You can do both. So it's a good chance to use it. If you want to learn Kappa IQ, it's really easy. You just go to YouTube, type Kappa IQ tutorial, and you'll find the guy with a haircut like mine that works for the Institute of Corporate Finance. He has a bunch of videos, but they're each like 10 minutes each, and he goes through it pretty well. You can learn it. I learned it one summer. I thought it was going to take me all summer, but I was shocked how quickly I could convert a Bloomberg spreadsheet into a Kappa IQ spreadsheet. So you can get it on your resume. I don't know what percentage of our alums are using Kappa IQ versus Bloomberg. They're 80% using one or the other. I never heard of Kappa IQ 5 years ago, and now I'm hearing it all the time, and it really is very, very good. It's a true. We used to think of Bloomberg as a monopoly, but Kappa IQ is a true competitor. So if you're not using either one of those, use them. If you're taking Capstone, Kappa IQ can really help in your Capstone class because it's a source of data. I don't know a lot of professors even know it exists, so you can find data. So, get out there and learn it. You don't have to spend 20 hours a week, but you could spend an hour a week and add something really powerful to your resume. The firms that have hired students that were learning Bloomberg, they said they start working there. They don't need training. They already know what to do. So it gives you a huge advantage on that first job. The biggest problem with the first job is where's the data? How do I get it? And if you already know where Bloomberg and Kappa IQ are and your firm has it, you don't need anybody to train you. You just say, hey, no problem, I got it, I'll get it. And you sound like a genius in your first week, which is kind of cool. So, all right. So the exam's still a ways off, but just to get you prep, I want to look at the rubric for the essay questions. So your exam question in class will be closed book, will be the balance sheet immunization problem. You know that's coming. We'll practice it again. I'm going to keep, I've been reading this book. The key is comprehension, retention, and application. And the key to those is spacing, writing, spacing, and quizzing. So we'll keep trying that. So cramming at the last second is of zero value to you, but looking at something after 2 days, and after 5 days, and after 10 days, it makes it go into your permanent memory. So we'll do a little bit more of that. We have some easy value risk problems for the first exam, just to make sure you know the problem, know the basic formulas you're seeing value risk in your paper 1. And the second exam, there's a much more intense value risk problem, looks more like what your banks are doing. So we'll do that. The math is much more intense, but the first exam, some real simple problems. But then this last question with my blog and Arnott's article, let's just look at the rubric so we make sure everybody understands. So Arnott really had 3 groups of risk, but I said 4. Y'all remember what those are without looking them up?
Asset liability, career, and the first one, peer.
Peer risk. All right, very good. So peer risk and career risk go together because most firms are not managing their clients' risk; they're managing their own career risk, and their firms are managing their revenue base. So their goal is what? Don't get fired. It's not to do a good job; it's to not get fired. I remember General Facilio at UTSA, he's a brilliant guy. Oh my word. He was so complimentary. He said, Ron, you're so smart, you know everything. And then he'll introduce me, and then he'll say stuff that it's like, man, he's over my head. Brilliant, man. I don't know what his background was. But he says, you finance guys, you have these advertisements that come to us, we'll take up all your risk for you, just trust us, and then you don't do anything. You think the stock market's going to crash, and you go from 60% stocks to 58% in stocks. You guys aren't doing anything for me. You're just protecting yourself. So he understood that. So that's the peer risk. You're getting paid based on how you do versus your peer, and then you're getting paid not to lose your clients. So it's all about career risk. Asset risk is just the risk assets fall, and ALM risk is what I think is the most important one. Where does this second group fall? It falls under that 4th risk, ALM. Arnott doesn't talk about it in his paper. He only talks about interest rate risk. But anybody remember those 4 ALM risks? I just mentioned one of them, but You say inflation?
No, anti-selection.
Oh, anti-selection, all right, so that one's kind of a tough one, right? That's the healthy people take the pension, the unhealthy people take the lump sum. Longevity, yeah, people living a long time, that's something that could crush Medicare and Social Security.
Inflation is one.
Inflation, yeah, most pension plans have a cost of living adjustment. The USA's was CPI times 0.8 up to 10%, which is pretty powerful.
And there's interest rate.
Yeah, interest rate risk is just the one Arnott's focused on. He doesn't talk. I think he hints at inflation risk. I think he said a tip might be the perfect asset for this. What do investment managers and consultants focus on of those four risks that Arnott has? Yeah, well, peer risk, but essentially career risk. Why? Because that's how they're compensated. That's what I mean by incentives. We're paid not to take care of our clients. We're paid to keep their money, and we keep their money by not being too different from the competition. And I sound cynical, but that's the way the real world is. All right. Which of the four risks is the biggest?
ALM.
ALM's the largest by far. That's easy to put into your essay because you can't just quote Arnott on that, even though the numbers are really old. So the difference in his article and today, when his article was written, the accounting masked all the risk of the ALM side. That's not true anymore today. When stock markets move, interest rates move, the liability and assets, it goes right through net income. And so the numbers he's showing are probably even more true today. There's just not as many pension plans. So the longer term liability, that's why I gave you that box. So you could actually do it in your paper. I'd love to see it on your essay. Is that $500 in 3 years and $500 in 30 years? I think that's a simple way to do it. So all you have to do is discount $500 at 7%, at 5%, at 9%, and you just show how much more sensitive the 30-year is than the 5-year. The bulk of the liability is where? It's in the 3-year, right? Because it has the shortest duration, so its present value is much higher. But where's most of the volatility come from? The 30-year, because it has the longest duration. And so what does Arnott recommend? Hey, you have this huge advantage. A very small part of your liability is in the long term, but it's the bulk of your risk, which means a small allocation, you can eliminate huge risk. So he's not saying, hey, you have to put 100% of your portfolio. Hey, if 10% of your liability is creating 60, 70% of risk, hedge at 10%. So he's not saying you have to do much. So his awkward sentence that I rewrote, firms have too little in bonds, and the bonds they have are too short duration. Most pension plans have bonds with a duration of 5 years, and they only have 30% in bonds, and they got this liability with a duration of 18 years. It's like the bonds are a waste of time. They're not even of any value to them. Questions on that one, on Arnott's recommendation? Makes some sense. You can eliminate a lot of risk without much effort. It seems to make a lot of sense. The symmetry, you can talk about that at the same time you talk about this one, because what are we saying? When interest rates fall, the liability goes up a whole lot more than it falls when interest rates rise. He gave actual numbers. You can use my $500 to do the same thing. It's pretty easy. You just discount. Y'all remember how to discount the cash flow, right? Anybody remember 500 bucks? What do you do? 7%, 9%, 5%. The liability is $500, 30 years. What's the present value at 7%? Y'all make me really nervous on this. What's the present value of $500, 30 years out at 7%? Everybody remember that? I don't know how many parentheses I need. So that's going to be a much smaller number than the 3-year. But not only that, when the rate rises to 9%, the liability falls. When the rate falls to 5%, the liability rises, but it rises 76% when rates fall. But it only falls 43% when rates rise. That's the asymmetry. Everybody see that asymmetry? It was another way of saying that asymmetry, using fancy words from my investment class. Convexity. It has what kind of convexity? Positive convexity. We love positive convexity if it's an asset. This is a liability. So that's really bad. Positive convexity, that just means it goes up a lot more when rates fall than it goes down when rates rise. It's positive convexity. You love that with assets, you hate that with liabilities. So you see how you could answer that entire part by just using numbers. For example, say you had a liability with 3 years ago, $500, 30 years ago, $50. You could do the entire thing just doing that table. You see how easy that table is. It's a pretty simple table when you look at it. Much simpler than what Arnott had. His was just far too, he was trying to over explain it, I think. What is Arnott? So Arnott really has two recommendations. He says balance the three risk. Is that my recommendation? No, I say focus on the one that's the biggest. Forget the other ones. And then he says, or at least try to get 2 out of 3. That to me even makes less sense to me. So again, it's the guy with the gun on your head. You know, well, let's see. I got a gun on my head. I got a dog biting my leg, and I got high cholesterol. If I can get the dog and cholesterol away, I think I'll be okay. That doesn't make sense to me. Take care of the biggest risk, and then the others you can take, think about later. But he's saying, well, let's balance 2 out of 3. Take care of the biggest risk out there. But he does say you should at least try to get rid of the biggest part of that liability risk, which is that long tail part of it. Y'all stop me if you have questions. What is my recommendation? Now we're going to talk about options here a little bit later. There's students who get confused that that's my recommendation. It has nothing to do with the pension plan. How would you define my recommendation in 3 words? No verbs. Balance sheet immunization. Right? Balance sheet immunization. No abbreviations. It's balance sheet immunization. I once had a brass group, we're going to call it Sweet Sound of Brass, and they didn't like Sweet SOB as our acronym, but yeah, spell it out, balance sheet immunization. So you have to maybe explain what balance sheet immunization is, but it's making sure those assets are going to go up a bunch when the liability goes up a bunch. You're okay if they fall as long as the liability is falling. So you're trying to immunize, and mainly you're immunizing, and really the only thing you're immunizing is interest rate risk, longevity risk, anti-selection risk, inflation risk are all very difficult to manage. We did manage inflation risk a little bit, and our approach was we made our assets a little bit shorter in duration or liabilities. And that was somewhat how we managed the inflation risk, but it's tough. Inflation risk is a really, really tough one to manage. All right, so that's my recommendation. A good way to talk about my recommendation is how I reported it to the board. So I just told the board asset return, liability return, difference. I went from I don't know how many pages of presentation to 1-page presentation. It was incredible. It used to take us an hour or more, and then it was like 5 minutes. Any question? It was so easy. Just eliminated so much time. Which is all the board should have been worried about, because they had this liability. They got to pay these people. Hey, you know, you had enough in assets to pay it last quarter. You still have enough. Everything's lined up. There's no difference. Everything's taken care of. This is what you hired us to do. Problem solved. Very, very simple. So this is my approach. Notice I don't have anything about which managers are outperforming or underperforming. Our entire stock portfolio was indexed. We had the surplus of the plan, some of that in the stock market, but the liability itself was hedged. And the asset risk, we didn't worry. If the assets are down 10%, who cares? If the liability is down 10%, we're fine. So even the asset risk, we weren't that worried about. And then my blog. So I'm lining all this up, and why do I think balance sheet immunization is the best answer? And I start off with, my blog's in a little bit different order than this, but I start off, you probably want to discuss that pension liability. It's not really debt because it's And it's just extremely long duration and it has inflation risk. So it's like debt, but on steroids. It's an extremely high sensitivity to the economy type of debt. So firms go out and borrow 5 and 10 years notes. That's pretty short duration, no inflation risk. A pension liability has very long duration, so it's very sensitive to interest rates. It has cost of living adjustments, very sensitive to inflation. It's a very high beta liability. So just the simple fact that a firm has a pension plan, it's going to do what to its weighted average cost of capital? Increase it dramatically, even more than normal debt does. And so if you're going to try to increase the value of the firm, you can either increase free cash flows or reduce WACC. What does investing in the U.S. stock market do to your free cash flow? Well, technically, ignoring expenses does nothing. It has a net present value of 0 because your discount rate reflects the fact you're just buying stocks. Now, after fees and management fees, yeah, it could actually decrease. What does investing in long-term bonds do to your free cash flow? Nothing. It's just the present value is 0. What does investing in the stock market do to your WACC? It's going to increase it. You're just adding more beta to the firm. You're just more exposing your stock investors to the market. What does immunizing the balance sheet do to your WACC? Reduces it dramatically. Just taking this high beta liability and you diffused it, essentially disappeared. So how do you increase value of the firm? You increase value of the firm. The only way to do it with that pension plan is to defease, to immunize that WACC, because by offering a pension plan, you made your firm much more risky. It's going to move a lot more with the overall economy than it was. But if you can diffuse that, you're good. It has no impact on free cash flow because you're buying bonds at the correct value. So we covered all those. And then the last thing is, why do you have a pension plan? You have a fiduciary responsibility. You remember the words? Act only in the best interest of the plan participants. And you make a strong argument for how buying stocks in a pension plan is in the best interest of the plan participants. I could never make a good argument. I tried it with my lawyer and he didn't buy that. So if I can't make that argument, but that guy from AT&T is not here, so I can't get his side of it. So the implications are, my bottom line on this is pension plans should have been managed like life insurance companies all along from the start, and we wouldn't be having these big blowups today. It was the obvious solution. It was the right model. And life insurance companies don't necessarily have a fiduciary responsibility, but they understand, actuaries understand the risk very, very well. So now, if you look through that, try to figure out which of those is most confusing to you. Read through them again. If you had to do the exam right now, off the top of your head, not open book, which of those would you fail on? I got it. Anybody? This came up in the interview. Anybody could walk through it pretty well? I love this question because it draws so many of your classes into it.
What's the date of the test?
I don't know. I can't remember, but it's not tomorrow or next week.
This is one of this week.
In 2 weeks. Yeah, on a Thursday, right? So it's at the end of the week. So yeah, we still got 2 weeks. And the exams before paper one's due, so you have to work on this essay. So hopefully you've got almost all of your paper one done by now, and so you can get this essay out of the way and then jump back onto the paper. Oh, is it on Tuesday? All right, so we got a week and a half. So, but yeah, you may want to start working on this paper now that it's fresh in your mind. Some students struggle with my class because it's like, well, nothing's due this week, nothing's due this week, and then something's due, and suddenly you've got 4 weeks worth of work, and you can't do it. And my class is all about like a finance job. Finance jobs, I had an accounting job where you had something due every 5 minutes, and there's people constantly coming to your desk. Finance is like no one talks to you for 6 weeks, and then in 7 weeks, you better have something. You better have been working on it all the time because it's very autonomous, and that's kind of how my classes are structured. All right, so hopefully that's good. So let's continue on through the notes. Real quickly, life insurance, I've kind of already talked about them. They're the most complicated of all of these. Banks is probably the simplest. Pension plans are somewhat complicated, especially with the cost of living adjustment. But you saw with banks how easy it was to immunize that bank's interest rate risk. That's why Silicon Valley failing is just like not even understandable. A bank that big not getting the basics. Life insurance companies are the most complicated because they have what we call embedded options. They give their customers these rights to do things that are really, really hard to immunize. So the two biggest risks that they have is when rates rise, their customers take their money out and go somewhere else. So life insurance companies have what they call a portfolio rate. They buy 5 and 10-year bonds. And when rates rise, they can't raise their crediting rates that fast because they're stuck with these bonds that they bought 5 and 10-year bonds. Banks are new money rates. When rates rise, banks raise their rates immediately. So life insurance companies, as rates rise, what they can earn on a portfolio rises real slowly, whereas banks go immediately. So when rates rise suddenly, like they did in 2022, a lot of customers at life insurance companies say, hey, I'm going to take my money out of the life insurance company and go buy a CD. You know, this life insurance product's paying 4%. I got this CD paying 5%. Why don't I move my money? When rates fall really low, like they did in 2020, life insurance companies have these guaranteed minimums they have to pay by state law, and some of them are ridiculously high. I've had annuities with 3.5% minimums. Those are incredibly good minimum rates. So you're guaranteed 3.5%. I heard with our company, we had some like that. There were like 5% minimums, and we were calling and begging these customers, please, we'll pay you to get out of this product and move to this product. And those customers were smart. It's like, no, I got this 5% guarantee. Why would I move? They knew what they had. And it wasn't the stupidity of a life insurance company. The state legislators required them to have a 5% minimum. Why? Because these laws were passed in the early 80s when interest rates were real high. It's, oh, you should be paying at least 5%. They never thought that rates could fall. And USA had like $3 billion in what they call these legacy annuities, guaranteeing people 5% when they couldn't even make 3% on the portfolio. So it's a very, very, very tough business, and they're the best at it. That probably makes sense, right? It's the hardest, and so they're the best. They have actuaries. They don't have finance people. That gives them an advantage because the math is really, really tough here. So they get down to what's called key rate duration. You'll probably only hear key rate duration in a life insurance company, not in a pension plan, not in a bank, definitely not in a property casualty, where they're looking not just at the duration, but they're looking at buckets of duration. What do we have in 2 years? What do we have in 3 years? What do we have in 4 years? Because you can get the duration matched, but the cash flows can be all different. And they got to get the actual cash flows matched up. And it's I mean, it's pretty incredible. I was shocked just seeing what they did. Just incredible, the data they have, the understanding they had. So at USAA, we had 2 Johns. We had John the actuary and John the portfolio manager. John the portfolio manager is still at Victory Capital. But John the portfolio manager would call and say, I got to invest $100 million. Here's the 6 bonds I have. John the actuary take those 6 bonds, model them, and say that's the best one for us. That one fits, hits our key rate durations. It's just an amazing, amazing process. So we have some actuaries in here. That's why I always tell actuaries, if you're trying to decide between property casualty actuary and life insurance actuary, if you have any interest in investing, the life side's the place to go, because boy, they know interest rates, they know fixed income's better than finance people. It's truly amazing. That's why the actuaries I known at USAA on the life side, it's irritated the life out of me, but they said, oh, I'm going to take the CFA exam this year. I had to study 3 or 4 hours, and they passed it with no problems. It was like this exam that was just so incredibly difficult for me, and they're like, oh, it's a piece of cake, easy exam. It's like, give me a break. But they have so much background in some of the most difficult parts of that exam. So we won't get too much in it. It's just really beyond the scope of this class, but it's a very, very difficult problem. And it could blow up, and yet when you look at it, there haven't been that many life insurance company blowups in the last several years. In 2008, it was AIG, but they're not life insurance. We've had a few big life insurance blowups, but most of them were runs on the banks where they had real estate investments and they just couldn't get the cash fast enough. But those were years and years ago. Can y'all think of a major life insurance blow up? You can think of major bank blow ups, but can you think of a life insurance? I mean, they're pretty good at what they do. So it's kudos to them. Endowments. So I did USA's endowment. Endowments are like charities. So endowments typically have 60, 70% in stocks as well. The problem with that in 2008, you've got three parties here. So if you think about an endowment, you got the donors, you got the portfolio, and you have the clients. So a good way to understand the risk of endowment is go through the extreme. So in 2008, how are the donors doing? 2008, stock market's down 35%, total mayhem. Your donors are saying, what? Oh, I think I'll donate more this year. Is that what they're saying? Saying, you know what? I've lost so much money. I have no tax deductions. Why would I make a charitable contribution? I'll wait till later. So your donors have cut back. How's your portfolio doing? That's 60, 70% in stocks. It's crashed. What about the recipients of your charity? How are they doing? They need more money. They need more contributions. So it's, what do they call it? The perfect storm. The people you giving money are hurting. Your portfolio is hurting. The people you help are hurting. Everybody's hurting. Unfortunately, it's all going the wrong direction. You're getting less donations. Your portfolio is down, and your clients need more money. So is 60% in stocks really the right answer for endowments? Most of them, that's just what they do. It's inertia. It's pretty tough formula. I wouldn't put them 100% in bonds or anything like that. With endowments, and this is where people get confused when they ask about my solution for pension plans. One of the solutions I like for endowments is 100% equities, but hedged. So I like hedged equity. We're going to talk about hedged equity later. I like hedged equity better than say 60% stocks, 40% bonds. So what hedged equity does is you get a lot of the upside, not all of it, but it cuts that downside dramatically. So you can make sure you don't lose more than 10, 15%. So that protects you in those times where market's really crazy. But it's a tough one. I really struggle with the endowment. USA's endowments were kind of bizarre because their clients weren't people in need. They were just strange endowments. So they were small, a few $100 million. It wasn't massive, but it was a challenging one. So again, heavy allocation to stocks, short duration bonds. So they need something besides that 30% in 5-year duration bonds. So if you got something that's going to be a disaster and a disaster, then you need something that's going to be doing great in a disaster. And 5-year duration bonds or not. How did 5-year duration bonds do in 2008? They were down like 15, 20%. Y'all don't remember 2008, but in 2008, corporate bonds dropped dramatically. They were down 15, 20%. Why? Because credit spreads gapped out so wide. 2008 was a horrible year. If you had treasuries, that'd be great, but they don't put 30% in treasuries. They put 30% in corporate bonds, and corporate bonds crashed in 2008. Everything just crashed in 2008, except for treasuries, which is the one thing endowments don't buy. So long treasuries might be a better solution, at least in a crash. That doesn't help you in 2022, though. When inflation takes off, then everything's down again. So it's a tough one. I don't know if y'all have heard of Taleb's Black Swan investment. What's a Black Swan investment?
It's like a significant negative scenario that no one could have foreseen.
Yeah, so it's something that does incredibly well in deals. Everywhere else, 90% of the time, you just lose 100%, but it's a small investment. But 1% of the time, it's up massively. That's the Black Swan investing. We'll talk about Taleb more. Would Black Swan investing work? So one thing I would recommend that you look at. I've already forgotten. And man. There's an incredible YouTube video. of Taylor being interviewed by Kahneman, where he talks about the black swan. This, have any of y'all watched this yet? Because I recommend this. We're going to talk about Kahneman and Taylor at the end of the semester. It's a incredible. I would recommend you read Black Swan and Fooled by Randomness, and maybe even Thinking in Bets. So read Taylor, read Kahneman, and then watch this interview. It's a very fascinating interview. Taylor doesn't come off, I don't think, very well in this interview. Kahneman, I would not want to be interviewed by Kahneman. He asks these questions that just destroys the person he's interviewing, and then he just nonchalantly says, "Okay, well, let's go to another question." And it's like the guy's just sitting there squirming. But he really pushes Kahneman on this idea of a black swan investing, because he doesn't think most people can do what Taylor is recommending. But it's a great interview. So endowments need something that's just going to be crazy in a crisis, because they got 70% in stocks, which is going to be down a lot. That 30% is going to have, the 30% can't be up 3% or 4%. It's going to have to be up, some portion is going to be up really dramatically. That's why I say I like equities hedge, because options are one of those black swan things that when you have a crisis, they're up 45,000% or whatever. So it's tough. Endowments are tough to manage. So you can go to something like Harvard or Yale and their endowments. You've seen some of those. They do some pretty interesting things. A lot of private equity, a lot of infrastructure. They do a lot of stuff that's somewhat off the beaten path. I don't know why they have endowments. I don't understand endowments. I mean, the purpose of an endowment is you give money to somebody and you do it in endowment so they never spend your money. So, hey, I like this charity. I want to give you $100,000 and say, oh, good, we'll put it in the endowment, but we'll never spend that money. We'll only spend the interest off that money. That doesn't work for me, right? If you give your money to a charity, don't you want them spending it on the charity? What does Harvard do with this endowment? Takes a small fraction of the earnings and gives it to the students, and the rest, what is that thing, like 50 billion, isn't it? Size of Harvard. How do you spell Harvard? Endowment. $40 billion. What's that there for? What's its purpose?
So never, it's already been around for how many hundred
Yeah,
years.
its purpose is for it to get larger. That endowment exists. The Texas endowment's the same thing. We want to do a student run fund, and they want to charge us a fortune. I just finally figured out the purpose of the Texas endowment is for it to be a bigger endowment. That's why it doesn't, not to help education, not to do anything. It's there to get bigger. It's there to survive and get bigger and get more money. So yeah, you want a student fund? Yeah, bring it to us. We'll charge you a lot of money. We like getting more money. It's like, no, that you should. I wanted to have a student run fund for the education of students. Like, oh no, we're not in that business. We're in the business of getting money and investing it. That's what we do. It's like, why? $40 billion, and its goal is to be larger than $40 billion. And then next year, when it's 43 billion, what's its goal? Larger than 43 billion. That's the only purpose of these endowments. So that's, to me, really frustrating. I don't know why we have endowments like that. So I recommend 100% equities and hedged are, you got to do something that's going to protect you in those extreme cases, because it's going to be pretty brutal, because you have the donors and you have the endowment both going in the wrong direction. All right. We talked about career risk. I don't know if you've heard the prudent expert rule. The prudent expert rule is essentially part of the career risk. It says you need to do what a person with your education and background would have done in this situation, which essentially creates herding. If we all do the same thing, no matter how bad it is, we'll protect it. It's when you do something unconventionally. So we have a lot on the career risk that pushes us to do what everybody else is doing. That way we're safe. When I did my pension plan at UTSA, it was nerve-wracking to me because we were unlike anybody else. If something had gone wrong, I could have been sued personally. So when you go out on your own, you're in trouble. If you do what everybody else is doing, that's when you have risk. So it doesn't say a prudent person is someone who does what is prudent. It's what does what everybody else is doing. So it's not even asking if you're doing the right thing. So never fail by yourself. That's what the rules tell us. Fail with everybody else, and you're fine. So I think it's one of the hindrances to true innovation on the investment side, because everybody's scared to be unlike anyone else. So we all move in these herds, which means when we fail together, it's pretty brutal. So how can you get around with that? Probably the easiest way to get around that, if I were you, I would probably be going to family office. Family offices to me are not family clinics. So have y'all heard of family offices? We've got some here in San Antonio. I think we have a few wealthy individuals. So this is some wealthy family, and they're just having someone manage their wealth. And usually families like that, they don't worry about the quarterly gyrations. They let you do stuff that makes sense for the long term. There's some really good podcasts that talk about family offices, and I listen to them and go, wow, that's the place I want to work. Because you don't have to worry about what the crowd is doing. You just think, what makes sense for this money? What should we do? So family office would be a way to get around this, because as long as the family is not breathing down your back, you have the ability to do some interesting things. All right, I want to show you a little bit more on USA's pension plan. So 2008, I want to show you 2008. So we hedged our pension plan. I'm not showing you the stocks, but I'm just showing you the bonds. So we had $3 billion in bonds. Our liability was $2.7 billion. So our pension surplus was $300 million. And in 2008, interest rates fell about 200 basis points. So our liability, which had a duration of bonds, had a duration of 5 years. They went up to 3.3 billion. The liability, because it had a duration of 15 years, it jumped up to 3.5 billion. But we had the swap. The swap's market value when we entered it is 0. But it had a duration of 30 years and a notional value of 850. So you can do the math there. If interest rates fall 200 basis points, so minus 30 times minus 0.02 times 850, it's up $510 million. It went a little higher than that, but it went to $510 million. I was very distracted several weeks when it went 40 million, 100 million, 200 million, 300 million, 500 million. I was watching on my Bloomberg screen. It was like really cool. So I think 516 or something, but it went up pretty high. And so what happened to the planned surplus? Bonds went up, swap went up, our assets went up 3.8 billion, liability went to 3.5. What happened to our surplus? Nothing. Perfectly hedged. But what really happened? That's not what really happened. Y'all want to see the real? Well, I'm going to show you anyway. What actually happened? Bond interest rates actually went up because the corporate spreads gapped out so much. But swap spreads fell. I thought my swap was going to hedge my liability. But my bonds interest rates actually went up because I wasn't holding treasury, I was holding corporates. And because the liabilities are priced off for corporates, not treasuries, my liability went up. But swaps went, and I'm going to show you swaps, they went the opposite direction. So what happened? My bonds fell, my liability fell, but I got 320 million on my swap. Our surplus actually went from 300 million to $900 million. It's insane. That's why I said out of 1,000 pension plans, this is the only pension plan whose surplus went up, and it went up threefold. 999 went from a positive to a negative number. And we had fun with it because GE came in and met with us a couple years later, and they were bragging that they could do portfolio management because their pension plan only lost 20%. But its surplus went from positive 10 to minus 10. And so I'm in a meeting. I just jokingly go to, hey Ryan, how did our pension plan do? I'm just curious, can't remember. So we kind of gave them a little bit of a cold shoulder because the Pretty amazing. Now, how did we do that? We shouldn't have done that, right? We were hedged. So hopefully you're sitting down. So here's what we did. Here's the discount rate for the pension plan. Here's the swap. That looked like a pretty good hedge. What does the liability do when this falls? The liability shoots up. What does the liability do when this rises? Liability shoots down. Does it look like a perfect hedge? You got some few places here, don't you? But it's pretty good. It looks like a correlation 0.9 or so. It looks pretty good. Y'all want to see everybody's sitting down, right? I don't know if this is a 1 in a million year, 1 in 10 million year, 1 in 20 million. I just know this happens maybe once in your career if you're I don't know if lucky or unlucky, depending on what you go. All right, here we go. That's what happened in 2008. In November. Discount rate shot up. The hedge shot down. So the liability dropped and our hedge shot up. Exactly the opposite of what it should have done. You're not going to see this in your career. You'll see something else. That will never, I'm going to promise this will never happen again. That was very, very bizarre. Just crazy. So what should we have done there? So this is kind of a frustration in my career because I wasn't in this department anymore, but I bought that swap. So I was like, I don't want to lose this value. We're up 600 million bucks. My old department said, well, what they said back here was, committee, don't worry about it. These are paper gains. And so my boss comes back and I said, what do they recommend? I said, well, they're paper gains. You don't need to worry about it. I said, they're paper gains until you do what? You have a $500 million paper gain. What can you do? You can sell it, right? So I go, why are they saying that? You can sell this and buy that. That was my recommendation. That wasn't my recommendation. It was a recommendation of every fixed income person at USAA. Get out of the swap and put all that money in triple B corporates because you're going to make a fortune on it. Their recommendation, well, let's study it more. They said they want to do a strategic asset allocation. I said, this isn't strategic. This is tactical. There's nothing strategic about that. Sell this and buy that. I kept pressuring boss. He came in and slammed his fist on the table, and I don't know if he's mad at me or my old department. Fortunately, he's mad at the old department, but like he's like, they say it's just paper gains. We shouldn't do anything with it. That doesn't make sense. If you have a hedge and it blows up in your favor, don't say, oh, it's just paper. You can sell it and you can make transactions. Now, some people are saying this market was frozen. So if we had sold this for $500 million and bought $500 million of bonds, you say, well, the market's frozen. Why was it frozen? There were no buyers, right? What was I wanting to be? Buyer. If there's no buyers, is it good to be a buyer? If the market is completely empty of buyers, don't you want to be a buyer? What do they call that? Buyer's market. You know what the buyer's market is? We were in a buyer's market. Was anybody else buying at that time? Yeah, Howard Marks. Y'all heard of him. He was buying bonds during this time. He was putting $400 or $500 million a week in the bonds. There was a market. It's just that when you picked up the phone and said, I want to buy 100 million, they're like, what are you talking about? No one's buying right now. When you had people that were desperate to sell, selling out 60 cents, 50 cents on the dollar, they were willing to sell you. I mean, it was insanity. And how would that have worked if we'd sold this and bought that? How did this perform after that? Those bonds would have been up 30, 40%. What if we hadn't sold this? What would have happened? We'd have lost most of that gain pretty quickly. So you have to be paying attention. Their argument was we're hedged, so we don't have to do anything. And that's never true. Hedges can blow up. We're going to talk a little bit later. I don't know if anybody knows what this is called. What you're hedging and what you're hedging with going opposite directions is called basis risk or tracking risk. I don't know if y'all heard that term. We'll talk about that a little bit later. Basis risk is usually to your detriment. For USAA, it worked out in our favor. It was an incredibly lucky event. I think they ended up selling here. We were talking right here. I mean, on this actual day, we were talking, they sold here. So they probably threw away 150 million by waiting. But the fixed income guys where I work, their fear was December 31st. Because they were convinced there was some window dressing going on for year end. And once January 2nd happened, this thing was going to unravel. So that's what we were pushing on. At least get this done before December 31st, because you don't know what's going to happen January 2nd. People have stuff in their balance sheets because they don't want to report at year end. But once January 2nd comes, it's going to unwind. And it unwound pretty quickly if you look at it. So it was a pretty amazing year. And this wasn't even my job. I'm running equities that are down 35%. You know, so I'm already stressed out enough. So we don't need that. Everybody was just stressed out. No one was happy. It's just a horrible year. But that doesn't mean you stop doing your job. You still got to be paying attention, asking questions, challenging each other. I wasn't 100% confident. So I went around and talked to every single fixed income person I knew. I talked to the head of fixed income. He accidentally called me. I hadn't talked to this guy in years. I go, Cliff, why are you calling me? And I call him back because my phone wasn't ringing. And this is one of the things he brought up. Oh, I was so mad at those guys. Yeah, I was screaming at Chris about this. So this is one of the first things he brought up. It's like, yeah, we're all saying sell that thing. Why did they wait to sell it? They should have sold it immediately. So do you think that's the favorite part of my job or my least favorite? That's my favorite. That's when you're finance people. That's when you earn your salary. You're engaged, you're debating, you're fighting, you're arguing, and you're going to make the best decision for the customer or whoever it is, whoever the pension plan. I love this part about finance, but it's stressful. It's extremely highly stressful, but it's fun. This is where you earn your keep. All right. Fun times, boy. In fact, I saw the actuary worked with us on this, and the two of us were saying, you know, that was probably the best thing we did at USA in our careers there. It was a fun project, and it worked out extremely well. It was just amazing. And the other thing you think about is 2008, we had a new CEO, brand new CEO, Joe Robles, great guy. This is his first year in a financial crisis. Do you think it was kind of nice to go in and say, Joe, you know what? Pension plans are blowing up everywhere. Our pension plan just tripled our surplus, so you don't have to worry about the pension plan. Wouldn't that be a nice thing to be able to tell your CEO? It's like one stress you can take off your table. Don't you think Wayne would love to hear some low stress stuff right now? So yeah, I mean, you do your job, you can really change the company pretty dramatically. So fun times. All right, any questions on interest rate risk? Y'all see why it's my favorite risk? You have so much to work with. It's an exciting area, but very complicated, very difficult. Interest rates can do really unusual things, surprisingly. All right. No comments? Are y'all shell shocked?
Did USA not have like a max loss on that?
What do you mean?
Swap? Like where they're down 50 million?
No. You go all the way, either way, either direction. I warned them multiple times.
But in today's world, you would, that right?
I wouldn't have done the swap in 2020.
Like a predetermined loss.
If interest rates are 0.5%, I wouldn't have done the swap. No. When I did the swap, rates were really pretty high. And in fact, the day I traded, the 5-year was well above 5%. And so we hit it a really good time. There is, you know, they say hedging, but there's a tactical part to hedging. You don't say, hey, you know what, we're worried about this, and we're worried about rates falling. You say, well, interest rates are 0.5%. You know, it's like, I'm really not that worried about rates falling. When rates are 5%, like right now, I'd probably be a little bit worried about rates falling, and might not be a bad time to put the hedge on right now. Right now, it'd be expensive because you're paying floating and receiving fixed, so you'd actually be paying because the floating is going to be a higher rate than the fixed. The way that you'd actually be out cash flow wise. When I did my swap, the yield curve was kind of steep, so we were receiving more than we were paying. But yeah, I mean, it's a tricky transaction. Now, the way I got it approved, and it's interesting going through the approval because this is a pretty complicated transaction. And the pension committee is all execs, so they're busy people, and we meet once a quarter. So I went to each one of them individually and presented the whole thing to them. At the end of it, they're all like, yeah, this makes sense, let's do it. Then we had the meeting, and the CEO goes around and say, y'all understand this? And guess what they all said? No, we don't understand this. And so he chooses me, you can't come for something this complicated without going around and explaining. I just held my tongue. So I went and said, I was tempted to say, well, I'll explain it to them again. I didn't say that. I said, yeah, I'll set up a meeting and explain it to them. The second meeting went perfectly. The CEO was gone. So the chairwoman of the committee was a lady named Christy, who was the president of the life insurance company. And guess what her background was? She was a life actuary. Guess what she said? Absolutely. And everybody in the room turned to her and said, Christy, what should we do? Because they knew she was a life expert. And she said, we should do this. This makes absolute sense. I don't know why you wouldn't do this. So sometimes you're lucky, and I was lucky that she was the head of the committee at that time, because the committee still didn't understand it. It wasn't that they're not smart people. They're brilliant people, but they see this once a quarter and they got their own problems to deal with. So it's just really hard to get stuff like this approved. I did remind them, to kind of to Kevin's point, if interest rates rise, you're going to see some losses on this swap. I just want to make sure y'all are aware of that. You could have $200, $300 million losses on this swap. It would have been an unusual situation because interest rates were well above 5%. So, that would have been a pretty high jump. But yeah, I mean, there is the politicking of this, of figuring how to get things approved when they're just complicated, and figuring out how to get through the council. All right, liquidity risk. Let's talk liquidity risk. Liquidity risk has changed its definition since the 2008 crisis, because what happened before 2008, liquidity was, can you get cash when you need it? And that's without having to do a fire sale. So if your only asset is your house and you suddenly need $20,000 tomorrow, what would you do? You maybe borrow against the house, but how long would that take? You don't want to sell your house because that'd be too fast. If you need cash tomorrow, could you go to the bank and borrow against your house and have cash tomorrow? Do you think? Probably wouldn't work, because they're going to want what? Maybe an appraisal, maybe they want title insurance, maybe they want, who knows? So probably be too fast. So that used to be the own definition. If you need cash tomorrow, can you get it without a fire sale of some assets? You have something that's liquid that you can get cash pretty fast. That used to be the definition. 2008 changed that, because in 2008, even if you didn't need to sell anything, you were affected by the liquidity crisis, because nothing was selling, prices were dropping dramatically. So even though you didn't sell anything, you had a bond that you thought was worth 90 and it was trading for 40 because there was no market. And so when you have that kind of just absolute market free fall, you got to think differently about liquidity. You got to be worried about not your liquidity, about the liquidity of the entire market in this kind of crisis. It was frustrating at USA. There's something, I don't know if you've heard of this before. I don't know if I have it in the notes, but it's called price discovery. Kevin, you may hear this at Victory. I don't know, maybe not this year, but in 2008, you heard it. So price discovery is, so remember those levels, 3 levels? So you have level 1, which is stocks, real easy. Level 2, you got a good model. Level 3, there's not really any way. So a lot of bonds are level 2. You don't have a market price because they're not traded every day, but you have a model that tells you what that price is. And so level 2 assets, you run your model and you say, okay, this bond's worth 92 cents on the dollar. So you got an 8% loss. So you put that into your books. And then the portfolio manager says, 92, wow, I like that product. Let's go ahead and sell it. So you call the broker and you say, we want to sell the bond. And what does she say now? Oh, you want to sell it? Okay, well, the price is 75 because there's no market. It's worth 92 theoretically, but if you really want to sell it, we can only get 70 or whatever. We were seeing those type of massive, you don't usually see that, but in 2008, because there was no market, if you actually want to sell it, the true price is much lower. That's called price discovery. It's the price that actually is there when you actually want to sell it. And that was happening a lot in 2008. And so people are scared to sell anything. And then suddenly one person in Iowa has to sell because they need cash. So suddenly that 92 from the model no longer works, because now you have an actual live price of 75. So guess what you have to use now? You have to use the 75 because that's the latest price. That person in Iowa might have sold 0.1% of that bond, but it doesn't matter. That's the last trading price. So in 2008, that happened. I was on this committee that had to meet every time that happened, and I was there 3 years. We never met, and then suddenly in 2008, I saw those guys every single week. There was some bond blowing up every single week. It was very frustrating because they had to decide what price to put on this bond, and they also had to meet GAAP accounting requirements, so they're going to be audited as well. If they didn't put the right price down, it's going to cause issues. So that's price discovery. When you get into a liquidity crisis, there's no normalcy. Everything is just a mess, absolute mess. So you have to be worried about liquidity even when you don't need cash. So what are illiquid assets? Things like real estate and corporate bonds. That's what I mean by price discovery. Corporate bonds don't trade like stocks. They're not traded every single day. They're very infrequently traded bond. They're traded for large investors. A lot of corporate bonds are just held to maturity. It's pretty common. Hedge funds are changing that some. There's a little bit more trading going on with bonds. But for the most part, they're held to maturity. They're sold over the counter. There are exchanges, but that's not how these trades happen. And in a credit crisis or liquidity crisis, you really have no idea how much they're worth. That's why Lehman Brothers was so important. When Bank of America bought Lehman Brothers, they really didn't know what Lehman Brothers assets were worth. There's no real easy way to figure that out. And that's pretty tough. You're going to spend billions of dollars on this entity, and not Lehman Brothers, Merrill Lynch. When they bought Merrill Lynch, you don't really know what Merrill Lynch is worth because you can't get a decent price on their assets. But you're going to buy it anyway and just hope for the best. Liquid assets, stocks are very liquid. So don't confuse a fire sale with the fact that stocks are very volatile. Stocks are volatile. Their price can go up and down, but they're not that illiquid. So when you sell a stock, your sell doesn't usually cause the price to fall. If you have to sell your house tomorrow, that's going to cause the price to go down a bunch because you got to find someone willing to come in and buy it. But you selling your stocks tomorrow is not going to cause the stock price to go down. It might drop because of, like today, we got bad CPI data, but you're not causing the price to go down because of illiquidity. Stocks are very, very liquid. In fact, it's amazing. Have y'all put a trade in on a broker, online broker? How long does it take for that trade to go through? By the time when you click to look at your trades, what's already happened? It's already happened, right? It probably happened a billionth of a second after you hit the click. I mean, it just goes. Very, very liquid securities. Treasuries are liquid for the most part. I told my investment class last semester, and I told them this semester about 2008, where treasuries weren't liquid, not because you couldn't sell them, but because you couldn't buy them, because no one was selling their treasuries. They were clinging on to them for dear life. So I tell the story when we sold some of our options, $300 million on options. I tell Donna, I got 300 million coming in tomorrow. And she's like, what am I going to do with it? And I said, well, just put it in T-bills. And she's like, there are no T-bills. And I really seriously thought she was joking. But she was serious. I cannot buy T-bills. No one is selling their T-bills. I can't get them. That's where you start talking about negative interest rates. When people are actually willing to get a negative interest rate because they got to park that cash somewhere. You can't put $300 million under your mattress. I mean, Donna could try that, but you can't do that. You got to put it somewhere. And when you're a large corporation, you may take a negative interest rate just so you can park it somewhere. So treasuries are generally very, very liquid. 2008 was a case where, boy, it was just, you couldn't buy them. It's just like, where do you put your money? Agency bonds are very liquid. Asset-backed securities. Obviously, 2008, they're in the middle of the storm, but they're generally very, very liquid securities. You can sell them very, very fast. Options and futures are unfortunately very liquid. In 2008, we discovered that problem because in 2008, futures were so liquid that they were the first thing to trade. And so their prices got out of whack with what they were futures on because their prices reflect the fact people were selling fast and not the underlying. So in 2008, I was kind of disappointed. I was working at UTSA because there were some trades that were incredible that you could have done. I couldn't do them because of my job. So I'm like, do I stay here or do I quit? I mean, it's just some amazing things just got completely out of whack because of liquidity. Futures were liquid, so their prices didn't move like they should have. So in 2008, illiquid asset prices fell so much because of the liquidity, you had to pay attention even if you weren't selling them because you were having to mark these things down so far. I probably have price discovery in here somewhere. How often do we have a liquidity crisis? So we had one in 08. Had one in 04. When was the Russian debt crisis? 98. About every 5 years. We haven't had really one. I don't think 2020 didn't turn out to be a liquidity crisis at all. It looked like the bond market functioned pretty well in 2020 during the pandemic. So it was about every 4 or 5 years there for a while where we had liquidity crisis, where markets just froze. So where is the next liquidity crisis going to come from? I think I talk about here. I can't remember. I read this. Interesting, but he said, if you want to know where the next liquidity crisis is, look where the current liquidity is. Where people are buying a lot of stuff, that's where the next liquidity crisis is going to be. So if people are buying a lot of stuff right now, when that price starts dropping, they're going to be selling fast, and it's going to be your next liquidity. So what are people desperately buying today? I don't know. You kind of saw Bitcoins there for a while, kind of doing that, where people just buying up as fast as they could because the price was rising. So if you see people buying asset fast because its price is rising, that's probably going to be a liquidity crisis when that thing starts to turn. Have y'all heard the term Minsky moment? And I don't know how to spell it. Someone will. Where's in Wikipedia? There we go. Have you heard Minsky moment? So he talks about this cycle. So an asset price starts to rise, so people start buying more of it. Its price rises more, so people buy more. And then people start borrowing to buy that asset. Because now they're desperate. And then the price really shoots up. Well, now you got all these levered investors. So when the price falls just a little bit, guess what? They're in a lot of trouble because they're so levered. So what do? They start selling fast, and then the thing tumbles back down. And this happens a lot in the fixed income market. This is kind of typical. So where's the next liquidity crisis? Where are people borrowing money to desperately buy an asset? That asset's probably going to blow up in the next crisis. I don't know. Can y'all think of a place today where that is?
Video phone access.
Maybe individual stocks. I don't know. Stocks tend to function a lot better. It is an issue for brokers with people borrowing money to buy stocks like that because, if a stock can fall 50, 60%, you can definitely be in a lot of trouble as a broker and making your cash calls. So that's what you're looking for. It's probably a bigger deal on the fixed income side than it is on the stock side, but you probably could have something like that happen on the stock side. We had something not too long ago, but I can't remember what it was that was kind of in that camp. So the extreme lack of liquidity causes the asset prices to behave like we've never seen before. So all of our past history, all of our models, nothing works anymore. It's just completely free for all. We don't know what anything's worth. And then we're shocked at the concentrations. We'll talk about that when we talk about long-term capital management. So the Federal Reserve says, okay, we've got a problem here. It's, oh my word. Bank of America has a huge exposure to that. Oh, Citibank has JP Morgan. How can all of these big banks have this huge exposure? Because no one's monitoring that. And it becomes just a major, major crisis. So the Federal Reserve has an issue with this. So in 2008, the Federal Reserve's got to decide, is it a liquidity crisis or is it a solvency crisis? If it's a liquidity crisis, it's easy. You just flood the system with cash. If it's a solvency crisis, flooding the system with cash is going to make it worse. Because then you're extending the life of someone who's insolvent. So their insolvency becomes bigger. What if it's a liquidity crisis, but they think it's a solvency crisis? That's the disaster, right? Because they don't provide cash that would have solved everything, and then the whole system fails. So the Fed had to make a decision. What did they decide? Decided it was a liquidity crisis, bailed out AIG, bailed out a few others. Some people fault the Fed for that, but if you're in the Fed's place and you don't know which of these is, where would you rather err? Provide liquidity in a solvency crisis or not provide liquidity in a liquidity crisis? I'd rather give liquidity in a solvency crisis and then blame it on the next guy when it all blows up, because that's going to blow up months later. You don't provide liquidity in a liquidity crisis, it's going to blow up in your watch and you're going to get blamed in the history books. So I can kind of not blame Paulson for doing that because it's, that's kind of your fallback if you're not sure. I think Japan has had some solvency crisis. They've been propping up some of their banks that are really insolvent, and they just keep propping them up. They don't want them to fail, and they probably should just let them fail. All right. How do you measure liquidity risk? And the answer is we don't really know. It's a risk that's really tough. I don't know what have y'all been reading in your banks on liquidity risk. It's not quite as quantitative as the other sections, is it? It's kind of theoretical and subjective. It's just really hard. What measure do you do on liquidity risk? Stress test is one thing you'll see under liquidity. I don't know if you can really run a stress test because every situation seems so different than the previous one. So it's really hard to think what happens when markets freeze. And the question is, well, which markets freeze? We've seen this market freeze and it acted like this. This market acted like this. Is this market going to act like that, or is it going to be different? So it really comes down to who are the buyers and sellers and how concentrated are they? What are their other sources of liquidity? Until you get all that worked out, a stress test is not going to work too well. The other thing with liquidity crisis is you get unexpected correlations between entities and assets that you've never seen before. Suddenly, two things that are never related both crash at the same time because they're somehow tied together. It never happened before because this particular asset class has never crashed before, but now they both have exposure and they're both crashing at the same time. So yeah, here's what I just said. Where's the next liquidity crisis? It's probably today's most crowded trade. You can figure out what that is. You can get ahead of the curve and tell your boss, you know what, this may have another 10% to go, 20% to go. We should get out now because it's going to fall 70, 80% when it goes. Let's get out early. Make sure you tell your boss it could go another 10 to 20% just in case it does, so that they're not like, you idiot, why'd you get us out so early? Then it will go up another 40%, obviously. So what happens to your most crowded trade when the liquidity disappears? So that may be one way to measure it. Look at your assets, see what's going on with that. Unusual price movements up can be a good indication. If things are just rising way too fast, that can be an indication that something's going on. How do you mitigate it? Concentration limits. You make sure you don't have too much exposure to one entity or one asset class that could have a liquidity crisis like that. Make sure you're not exposed to one particular macro factor like the subprime mortgages in 2008. Stress testing is a good way to do it if you can figure out how to get the data to stress test it. Stress testing really comes down to who are the other owners of this asset, who are to be the buyers if I need to sell this asset. You can hold cash reserves, but that's kind of limited. You can't really hold $10 billion in cash. It's just, it's not a practical way. You personally, right? You can't have, I got a, you got this $20 million portfolio. I think I hold $5 million in cash. You're not going to do that because, you're just throwing earnings away. And then liquidity risk, liquidity reserves. When you test them, this is more the first definition. When you need cash, can you get to it? So we did that at USAA. We had a list of all our liquidity sources. So it included things like securities lending. I don't know if you've heard of that. But you don't have to sell your securities. You can essentially just borrow against them. You can get cash really fast doing that. It included subsidiaries. So if our bank was desperate, then our P&C company said they buy CDs from our bank. We got regulatory approval to do that.
I was just going to say that securities lending, you just go to the retail markets.
Yeah, it's very, very liquid. It's amazing. We're talking not millions of dollars, but billions of dollars really fast. It's a very liquid market. But could that market freeze up and be a liquid for a time? It's possible. So we went through every quarter, we went through our entire list. And the other thing we did, which I think is really important, is we tested them. So like on the repo market, let's borrow $300 million tonight and repay it tomorrow. Why? Just to make sure it actually works. So you don't want to say, hey, we have this repo deal with Frost Bank or whoever. Say, yeah, it's all set up. And you don't do anything for 6 years, and in 6 years you need it. So you pick up the phone, say, Maria, we're ready. We want to do 300 million. Oh, Maria retired 3 years ago. Oh, well, we're ready to do 300 million. They're like, who are you? You need to test it. So every once in a while, test it. How expensive is it to test it? You borrow 300 million. and maybe it's 4%. So it costs you $32,000. Is that worth it? $32,000 to make sure that liquidity is actually going to work? I would say that's probably a pretty good use of your money. That's not a terrible use of money. So you got to test it. Make sure it actually works. Make sure it's in place. You have the contract. So like with USAA, subsidiary transactions, you can't do them without state of Texas approval. So every single thing we did, we had to take to Texas and say, can this company buy this from this company? You got to set that up in advance, get the approval from both sides. P&C company, property and casualties, is regulated by the states. The bank is regulated by the federal government. Both regulators have to approve that transaction for it to work. So, you know, you have to test them. And that's one thing I loved about USAA is we actually tested them, make sure they would work and we could get the cash quickly. All right, that's the liquidity risk. It's hard for me to really, I don't know if you notice in Canvas what's under the module for liquidity risk. There's nothing there because there's not much I can give you. So, all right, so we're going to take the big risk next, which is price risk. Market risk for you, right? This is the one you're focusing on your bank. So we're probably gonna get more in the stuff for your paper one here. So, all right, I'll leave it there. I want to do price risk tonight, but there's one issue we didn't talk completely about, borrowing to invest. So for your retirement, you've got this huge liability. It's the same liability the company's covering with this pension plan, but I'm not recommending you go 100% bonds or to match that risk. Actually, I think you should probably be 100% stocks. But those who took my life insurance class know you as an individual have an asset that corporations don't have. It's called human capital. It's the present value of your future earnings, which looks a lot like a bond. Very long duration, has inflation protection, you know, looks a lot like a bond. And that for probably most of y'all, that's 95, 98% of your portfolio already. So you already get this massive allocation to bonds, long duration bonds. So you can freely go into stocks. We'll talk later why actually the second project, we're going to talk about why I don't think you should have 90% stocks, 10% bonds. I just think that's a waste of time. So I think people in their 20s just go 100% stocks and don't even look at the market. You might say, well, what if the US stock market just is horrible next 50 years? Well, if it is, so is everything else. So it doesn't really matter. You've lost either way. Nothing's going to work. So you might as well go for the higher return. Now, when you turn 40, 50, that's when you got to start thinking, because what is your human capital doing? It's getting smaller and smaller and smaller. So you have less of that fixed income. And then the other thing, you do have longevity risk. Just real quickly, I show this to my life insurance class, but how do you handle longevity risk? So here's someone who starts saving at 25 and they build a portfolio. And when they turn 65 or 62, they start taking money out. So they got 1.7 million. Is that enough to retire on? Well, if you die at 63, yeah. If you die at 107, maybe not. And so as you see, as she goes, it looks like she's got plenty of money. She's in her 70s. She's down to 1.5 million. Everything's going fine. Now she's in her 80s. That's fine. She's got plenty of money. Drops below 1 million. Uh-oh. So somewhere in her 90s, she's in trouble. If she's healthy in her 90s, she's in a lot of trouble because she has very little money left. So I tell my class that's when she's got to, what yarn in my class? Got to find something really fun, really dangerous, and not too expensive. So it's got to have high probability of killing her. It's got to be a lot of fun. So bungee jumping is probably too expensive. Skydiving is too expensive. But can we fix that? Is there a product out there to fix that? And there is a longevity product where if she'll take just $20 of that monthly investment, instead put it into a longevity product, this is what that product does. The same thing, she's just growing, and then starts taking money out. No big deal. Nothing really different. Oops, what's that? $1.9 million just came into her portfolio. What is that? That's the longevity product. What's a longevity product? It's just like life insurance. What happens with life insurance? You pay a $50 premium and you die the next day, you get $500,000. That's a really incredible return, isn't it? You got to die to get it. Well, this is the same thing, but the opposite. Here, everybody pays into it, but only the people that make it to 90 get money back. So her $20 that she paid in, will be worth 1.9 million. Why? Because all those other people died and left her money. It's called a longevity product. Now does she have to go skydiving? Now she can if she wants to, but she doesn't have to shorten her life. Now she's got plenty of money. Now she can make it to, well into her hundreds. So that's a great product. This is the product I tried to get patented at USAA. My CEO loved it, and the actuaries hated it. And he said, convince the actuaries and we'll do it. And they said no one would ever buy this product. I think it's a great product. It should be sold. But so I'm hoping one of my actuarial students will start their own company. They can hire me as a consultant, but I'm not a great consultant at 87, so they better hurry up and get going because I'm going to be too old. But I do think we can handle longevity risk. The life insurance industry is perfect. Why don't they sell that product? Because they can't make money off of it. So we got an industry that sells stuff they make money on, not what helps their clients. This is a product that they don't think they can make money, so they don't want to sell it. So we need someone who's got the client at heart. Okay. So we're going to talk about price risk and get into that last part of the exam. So you essentially have everything ready to go for the exam, especially getting an essay. So you've essentially got the first draft of your bank paper done. So now a good time to stop and write the essay for exam 1. We'll do another practice problem for exam 1 on the balance sheet immunization because I just want everybody to get that problem completely right. The price risk problems for exam 1 are fairly straightforward. So we'll see some of those hopefully tonight and Tuesday night. Price risk, pretty straightforward. Either an asset price falls or liability value rises. And what we just studied with interest rate risk is a subsection of price risk. You're seeing that in your banks. And they don't call it price risk. What do they call it usually? Market risk. And interest rate risk is part of that market risk. It's just a special case. It's just that with interest rates risk, we're talking about assets falling and liabilities rising because of interest rates. Here, we're talking about anything that would cause a price to rise or fall. So very straightforward. I don't know what your bank's definitions of market risk is, so I'll be curious to see what they say. So how do you measure this? So standard deviation is a measure of total risk. It's a measure that assumes a normal distribution and symmetry. So we'll talk about Taylor later, what he thinks about the normal distribution, how he thinks we over rely on it. We're not going to use, well, we will use standard deviation, but not in the way you're used. Well, in the second project, you'll use it in a more traditional way. Beta, we're not going to use much in this class at all, but you should be almost sick and tired of beta because you've had it in every class. You should know the formula for beta, how to apply it. You should be able to write a pretty lengthy paper on beta off the top of your head. But beta is the measure of the risk for an individual stock, assuming it's going to be part of a bigger portfolio. Valued risk is where we're going to focus, but using standard deviation. And if you're not writing about valued risk in your bank paper, you're missing something because every one of your banks has valued risk. Is anyone not finding valued risk in their bank? Should be pretty dominant. Is that a mitigation or a measurement? It's a measurement. Pretty common measurement for banks. The other thing you're seeing is stress tests. You should all see stress tests. That to me is a measurement. I've seen some banks put it under mitigation. You don't mitigate anything with a stress test. It's a measurement. Value risk is a more sophisticated measure of risk. A stress test is kind of a give me an indication what happens if this happens without any probabilities assigned. Value risk has a probability assigned. So it's the measure of how much you can lose or more at some given probability. It's very, very common. That was my P&C class. USAA uses VAR, but what do they call it? Anybody remember? We just studied it, Lauren and Gilbert. Huh?
Did you ask the question?
Oh, what do property and casualty companies call valued risk? Y'all just, huh? Probable maximum loss, exactly. And you're not even in that class. Are you in that class? Property and casualty?
Oh, yeah.
Are you? No, I don't think they are. Maybe it's like, wow, he knew it wasn't even in the class. Yeah, so USA, they call it probable maximum loss. Very similar concept, except for your bank's valued risk is a daily number. USA's probable maximum loss is an annual number. How much can they lose in a year or more in probability? A very similar calculation. There's 3 ways to calculate valued risk. your banks are probably using stochastic or historical. It kind of gets a little interesting. They're kind of a combination of historical and stochastic, but parametric is what we're going to use. This is the most straightforward. We use parametric at USAA some on the simpler stuff, and then the more complicated stuff we use stochastic. So parametric is where we're just going to use basic statistics, plug it into a really simple formula. This formula down here, very easy. Historical bar is essentially it's kind of like stress testing, but you just ask, what if the 70s happened again? Or what if the last 20 years happened again? 1% of the time, how much would we lost? So it's reliving history. And stochastic bar is when you're running simulations. I'll show you my simulation. I'm going to do a stochastic March Madness. I'll show you mine. It won't do very well, but I'll at least show you what I do. But the nice thing about doing it stochastically without my biases is I'll pick some Cinderella team no one else picks, because I'll have it in my model and it'll pick someone beating Kansas or something, and it's like no one ever saw that coming. But that's letting simulation or random number or whatever. So we did a lot of this at USAA. It was a lot of fun to do, but a lot of computer use power. So running simulations, your banks are probably doing some of that, probably historical or stochastic. Stress tests, it's just you're just running scenarios so that what we're doing on exam with the balancing immunization, that plus and minus 100, 200, 300 basis points, that's the stress test. Then duration and convexity, as we saw on the first part, interest rate risk is a major important measurement of risk for bonds. Duration's focused on what? Someone's in my class.
Weighted average time maturity.
Yeah.
Of all the.
Okay, that's the definition. Yeah. So what does it focus in on as far as interest rates go? So we are in my investment class, or we're in my investment class. I'll pick on them though. So duration is really focused on whether rates are rising or falling. The direction rate. But yes, the weighted average time to maturity. So the longer your duration, the more exposure you had, just like we saw on the duration of that word. Convexity is more focused on what?
It's the sensitivity of the sensitivity of a bond to the change in the extreme.
Change, the volatility, yeah. How volatile interest rates are. Why? Because convexity is a squared function. The squared function, you got to change a bunch before you even notice it. So duration is all we're focusing on here, but convexity is a good number to know. If you haven't seen it before, you can Wikipedia it pretty easily. An easy way to find convexity is to look up the term OAS, option adjusted spread, and just Wikipedia that, and you'll have a whole discussion on convexity. And so hopefully in John Tui's class, he's talking OAS. Has he brought that up yet? We are in John's class.
But he also gave us a spreadsheet that the formula on it.
Oh, okay.
So I have a good understanding of it.
So he's at least mentioned it. So it kind of depends. Yeah, you have to kind of decide on a class like that because you can spend the whole semester on structured debt. It gets pretty complicated.
That's what he was saying. Is he would spend too much time on the negative itself. So it's something we could look at.
Yeah. And we all know the duration for duration, but convexity is a massive formula. It's really tough. So bonds have much more specific measurements that they have for interest rate risk, just because it's calculable. It's a lot easier to calculate. Stocks were a little messier. So for this class, we're going to focus on parametric using this formula. You should have had this formula in a previous class, but you haven't. It's an easy formula. You can learn it in this class and not have to worry about it. But the mean or the average minus the number of standard deviations, which equates to some probability, times the standard deviation itself. So it's pretty straightforward. So if you look at, so y'all remember your normal curves, right? Y'all remember this from stats? Yeah. So how much of the curve is 1 plus 1 minus 1 to plus 1 standard deviations? About 2/3. And then 2 standard deviations, how much of the curve? About 95%. And 3 standard deviations, 99. So that's what you learn in stats. In this class, that's risk management. So which side of the curve are we looking at? We're only looking at a one tail side. We're looking at the downside. All right, so we're going to be a little bit different. We're not looking at how much is in between. We're looking at how much is to the left of this going over. So you've got to know which normal curve to use. So you pick some probability. So 1%, if you're only on one side of the tail, is 2.33 standard deviations. Anybody remember not 5%? 1% is 2.33, 5%. I heard it before. 1.64. That's not familiar. So 233 for 1% event, 164 for a 5% event. So we're going to calculate our bar like that. You're going to get a negative number when you do this formula, but you don't write it as a negative number because we know it's a loss. So you don't say, hey, our VAR is negative 50. You're seeing that in your banks, right? Your banks aren't saying our VAR is negative 47 million. They're saying our VAR is 47 million. If their probability is 5%, they think they're going to lose 47 million or more 5% of the time. So we just express it as a positive number. How do you mitigate this risk? We're going to get into this a lot more for the second exam, but the number one way you mitigate price risk is through diversification. We're going to have a long discussion on diversification. I'm going to ask the heretical question, does diversification work? And you might not like my answer, but we'll get into that. But that's the number one tool in finance. And it does work really well, except for when you need it. When you don't need it, it works great. When you really need it, it falls apart pretty horribly. So correlation, diversification, make sure you don't have everything in one place. This is the formula for the second exam, but hopefully you know this formula. If you're not a finance or stats major, you may never seen this formula, but you'll get it in this class because you're going to do it more than you want to do it. So you'll get it. It's not a horrible formula as far as memorizing it because it's repetitive. It's a horrible formula to stick into a calculator. So you'll just have to practice that some. But hopefully y'all seen this formula before, but we will get into the second side. But diversification is our protection, and correlation is how we measure that diversification. Do we want high correlation or low correlation to get diversification? Low correlation, right? Gold's probably the perfect example. Really volatile asset class, but tends to have a negative correlations. And if you have a negative correlation, high standard deviation actually helps you because it means it usually goes in the opposite direction and it moves a bunch. That's what you want, right? If you're in a crisis, you want something that's up a bunch, not something that's up 3 or 4%. So we'll get into that more in the second exam. And then risk limits is the other thing you should be seeing. So in your banks on measurement, you'll definitely see value risk and stress tests. And on your mitigation, you'll definitely see diversification and risk limits. If you're not seeing risk limits, search on the word limits. It's going to be in there somewhere. You're going to have that. How do you find correlation? Well, they'll call it something different, but in your VAR table, you notice that big subtraction they do. You know, look for that big subtraction. That's what they call it. They have different terms that they call it, but that's the diversification effect. So they add up all the risks, it comes to $200 million, but then they subtract 94 million for the diversification effect. So those are four things all of your papers are going to have: value at risk, stress test for the measurement, and diversification and risk limits for the mitigation. I call it risk budgets. I don't think anyone uses that term anymore. It was out there for a while and it's kind of disappeared as a term, but risk limits is a more common term to use. So we're going to be focused on this. On the first exam, that's just this formula, just plugging the three numbers in. So it should be fairly straightforward. So the measurement with VAR is how much we expect to lose at some probability. The mitigation, the risk budget, is how much we're allowed to lose. So we say, hey, we're expected to lose $50 million 1% of the time. We're allowed to lose 55 million, so we're okay. We don't have to do anything. We're expecting to lose 50 million, but our risk limit is only 40 million. We gotta cut back risk somewhere else. I may have talked to you about Will, who was up in Austin. He's in Houston now, but he went to a prop desk And I went and visited with him, and it's really interesting. Yeah, the prop desk, you just have a bunch of people trading. And the owner is like hoping they're all doing well, and Will was like, I got my value risk and I got my risk budget, and I'm sticking with it, and I'm the only one in this room doing that. Everybody else is this, you know, Wild West, just shooting from the hip. He said, I got my risk, but if I'm over a risk budget, I'm going to cut back. So he was using what he got out of this class to manage his risk because he didn't want to have a massive blow up happen to him in that job. But that's the approach. So let's go through the process. The first thing you got to do is pick your risk tolerance. I'm giving you the risk tolerance, so you don't have to do that. But how do you figure out your risk tolerance? So most of your banks, I think, are using 5%. I think I've seen some 10%, which seems kind of ridiculous, but I think Goldman Sachs is either 5 or 10. I think Bank of America does 5 and 1%, but they don't say 5%, do they? What do they say? They say 95%. They go the other direction. But at USAA, it was always, 1% or 0.2%. So how do you pick your risk tolerance? For most firms, it's what credit rating do they want? If you want to be AA, single A, you're going to have a really, really low risk tolerance. You're going to be like 0.2%, 0.5%, something really, really low. If you're okay with being triple B, you can have a higher risk tolerance. What about for individuals? It's just incredibly subjective, but we generally say younger people have a much higher risk tolerance than older people. As you get older, you just can't take those risks as much. But we don't know what it is on the second paper or the project. You're going to have to put a risk tolerance in, but I'm going to make it really easy for you. You can kind of just pick a number. If you're doing a 70-year-old, you might use 1%. If you're doing a 20-year-old, maybe use 5%. But we'll get to that when we get to that part of it. We don't really know what this is. We really haven't figured out a way to measure an individual's risk tolerance because it varies dramatically. And probably the biggest problem is during good markets, people say, oh, I love risk, I'll take a bunch. And during crisis, they're like risk intolerant. And that's the worst possible combination. They're aggressive for risk when they should be cautious, and they're cautious when they should be more aggressive. So we don't make good decisions when it comes to, there's a lot of kind of the subjective kind of human factor impacting that. You may not realize how much credit ratings impact firms. Firms don't make major decisions without considering the impact on their ratings. There's been some firms that have been really irate because they said they talked to Moody's and told Moody's what they're going to do. And they think Moody's said, we won't downgrade you. And so they did what they're going to do, and they got downgraded. And Moody's says, we didn't promise you anything. We just said, as far as you can tell. And they just get really, but you said we'd be okay. So firms check on that, make sure everything's fine. But it has a pretty big impact. Once you do that, you calculate the VAR, which is just simply plugging in the number. If you're doing parametric, it's just plugging numbers into a formula. If it's historical or stochastic, you got to run some computer models, but that's going to be pretty straightforward in this class. You compare that to your risk budget or risk limits. If your VAR is less, then you don't have to do anything. If your VAR exceeds it, you've got to reduce risk somewhere. You got to make some decision. You got to buy some insurance, or you got to buy some options, or some protection, credit default swaps, or something to protect you from the tail of the distribution. As far as individuals, yeah, y'all know some of y'all know I badmouth risk tolerance questionnaires. Risk tolerance questionnaires, they first ask, are you willing to lose money in the short term if I can make money long term? I don't panic when the stock loses money. So those questions are about how to react in a crisis. Those are horrible questions because people answer much more aggressively in bull markets and much more conservatively in bear markets. So they're kind of questions that force people to buy high and sell low. They're just horrible questions. They ask you if you're an informed investor. I don't know how that has anything to do with your investing. So uninformed investors have 50% in stocks, and informed investors have 70%. I don't know if that really matters all that much. So that doesn't make sense. And then the one question that matters is your horizon. If you got 50 years, you can be more aggressive. If you have 5 years, you can be less aggressive, especially if you have a huge human capital. But I hated this questionnaire. The reason I didn't like it is, you know, if you answer, let's say, this question and this question inconsistently, like you can't really believe those two things. The questionnaire didn't do anything. Didn't stop you and say, maybe you should go back and read the question again, make sure you're understanding it. So I went through and I did the answers, every single possible combination. I was shocked at the different asset allocation recommendations that came back. And I talked to financial planning. Do you realize if you answer C here and B here, your allocation goes from 70% stocks to 50% stocks? And that no one had checked that or thought about that. That's out there on the website. It's like, that just seems crazy to me, but it's out there. The only question I think should be there is this last one. It's the only one that matters, but it's tough with individuals. It's tough to come up with that answer. Wealth managers don't like me to say that because they want to say we're real sophisticated. We have these models and all that, but there's not much science behind it. It's more just subjective feel of hoping we got something there. All right, let's work some examples. So there's a couple ways we can do it. On the first exam, I keep it very simple, but I'll give you a risk tolerance and you calculate the VAR. That's the simplest thing of all. I could say, this is your maximum loss that you can bear. What's your probability of hitting that given the numbers? So that's just a matter of backing into it. And I'll show you both ways we can do it. So let's start with Uncle Todd. I'm not going to work all of these. In fact, what I'm going to do next week is I'm going to give you previous exam questions because they're actually pretty straightforward. These were actually harder than the exam questions. So if you're like worried, like you're only 90% there, then you'll be 100% when we do the exam questions because they are a lot more straightforward. All right, so he wants to buy U.S. large cap stocks. What standard deviation would you use for U.S. large cap stocks? The S&P 500. 10%, 15%, 25%, 18%. What?
1.01%.
Well, not daily.
Oh, okay.
Annually. So we're using annual numbers here. So historically, it's been in the 15 to 18% range. But how could you quickly know what the market's thinking right now? Is there a ratio you could use to find that? Y'all heard of the VIX ratio? So right now, the VIX says 14%. The VIX tells you what the stock market thinks standard deviation of the market is next 3 to 6 months. That's a low number. The VIX is really, really low right now. Where has it been? Can you see the 2008 crisis? Can you tell that's 2008? VIX got up, well, got a lot higher than that. Here's COVID. So you see how VIX shoots up, and it's very closely related to the actual standard deviation of the market. So the VIX, the VIX is a projection of standard deviation, but it's highly sensitive to the last 90 days of the market. So it tends to move somewhat. If you were to actually graph the annualized 90-day standard deviation of the market with VIX, it would be really close. VIX follows really closely the recent history. How low has it been? Look at that. It got below 10. That's a really low number. Guess what I'm doing when I see that number? I'm buying options. That means when the VIX is low, it means insurance on the stock market is really cheap. And it also means stocks are really risky. So it's kind of backwards. Why? Because the VIX is low. That means no one's worried about risk. When do you want to be worried about risk? When no one's worried about risk. When everybody's worried about risk, what do you want to be doing? You want to be buying stocks. But when no one's worried, that's when you want to be worried. But the nice thing is, that's when insurance is the cheapest. So we'll get into that when we talk about options a little bit. But yeah, the VIX, the normal number for the VIX is 15 to 17, 18%. So 14 is pretty low. That's not low enough for me to be buying options. If it gets down to the 10 level, I'm going to be doing some trades to take advantage of that because insurance is just really, really cheap. So this is not the actual standard deviation of the market, but it reflects what the market's thinking in the next few months. And it should have some relationship to history, but that's below average right now. And it even fell 2.57% here.
Does that represent the number of shares being traded when you say volatility?
This is the volatility. We're going to talk in a call option or put option. There's an assumption about volatility, and that's the assumption that's in the option market. That's the actual assumption. So yeah, essentially this is the market's forecast of standard deviation in the next 3 months. The stock market. All right, so he's going to use 15% for his standard deviation. He has a risk tolerance of 1%, and he doesn't want to lose more than 20%. That's his risk budget or his risk limit. Can he put all of his money in the stock if the expected return is 8%? So his risk tolerance is 1%. So let's get this. So let's do a normal curve. So we're doing a one-sided tail, all right? So you're used to a curve that says how much is between one standard deviation on either side. We're not doing that. We're all on the left side. So we're going to use a normal curve. So just stay with me here a second. You may have seen these in textbooks, but if not, I'm going to give you these numbers so you don't have to actually do this. So what this is going to tell you is how much of the curve is to the right of this manner of standard deviations, all right? So if I use the formula norms dist, NORMSDIST, and I take 0 plus 0, how much of a curve is 0 standard deviations from the mean? To the right of that. So you're right at the mean, and you go 0 standard deviations to the left. How much of the curve is to the right? 50%. So hopefully it says 50%. How much of the curve is 2.33 standard deviations? Let me put some freeze frames in there. How much of the curve do you think is 2.33? I hit enter, what should I see? So we move 2.33 to the left. How much is to the right of that? Just said it, so hopefully you remember. What number should you see here? 0.99 maybe? Right, 1% of the curve is to the left of 2.33 standard deviations, 99% to the right. So if you look at this curve, we go, here's the mean, right? The mean's right in the middle. If we move 2.33 standard deviations over here, then 1% of the curve's to the left, 99% is to the right. All right. Well, y'all got question marks on your face, so we'll keep doing this. What if I go to 1.64 standard deviations? What I'm gonna see? 0.95. It's gonna probably be about 0.955 or something. 0.9515. So about 5% is to the left. You go 1.64 standard deviations, 95% is to the right. All right.
You did 1.66.
Oh, 1.64. Sorry. It doesn't move much, right? If you go another 0.1, 0.2, it doesn't move all that much. 10%, I can't remember what 10% is. That would be interesting to see. Getting close. Getting real close. that looks like that's it. So 10% is 1.28. So Goldman Sachs is using 10%. They're talking about a 1.228 standard deviation event. All right, so if you do the normal curve, we don't need to go out 12, but we'll go out 12. These are the probabilities, and as you move left on the curve, there's more to the right, less to the left. So how much is to the left? 1 minus whatever's in here. So if someone were to ask, what's a 3 sigma, how often do you see a 3 sigma event? To the left, what would you say to that? Plus 1 minus 0.9987. That happens about 0.03% of the time. Pretty rare event. How often do we see a 6 sigma event? How often you're going to see that? Will you see this in your lifetime? So let's say you live to be 150. How many times should you see that event? Not very often. So should you see a 6 sigma event in your lifetime? You really shouldn't see one. Be pretty rare event. So pretty rare. We'll look and we'll look at 2008 and see. In fact, yeah, we're gonna see some numbers that somewhat back that up. So this is what we're talking about with number of standard deviations. Your number of standard deviations is this outside part. So a 1.64 standard deviation event. So if someone says my risk tolerance is 5%, and you say, oh, it's a 1.64 standard deviation event. Or you say, I'm going out 1.64 standard deviations. Oh, that happens about 5% of the time. 95% of the time we're above that, 5% of the time we're below that. All right. So you should have had this in stats, but it may be a while. But if you forgot it from stats, you need to remember it because we use it a lot in finance, as Taylor will complain about.
Are those called Z-scores? Is that what you get?
I've heard Z-scores like that. We don't use that term in finance, but yeah.
1.64.
Like T statistics and those kind of things, you're talking about, yeah, how far could you be from that number?
Yeah, in stats, they call that top part alpha. That's when 0.05.
Yeah, you're trying to figure out, is this possible? By using standard deviation to tell you how far could you get, and you see how far you are and say, wow, could that actually happen in real life? So yeah, it's kind of that how far away from the expected you can be. But we'll look at some, 2008 and even 2020, we had some events that were off the charts. We're talking not 6 sigma events, we're talking 10, 11. How often do you see an 11 sigma event? What does Bill Gates say for an 11 sigma event? No, it's not. It's 0. He gave up. He gave up around 8. So I don't know how many decimal places he could go out, but he just gave up at 8. An 8 sigma event you should never see. An 8 sigma event is you walk outside, you get bit by a rattlesnake. As you fall, you get hit by a plane part falling from the sky, and you hit the ground, a rabid dog bites you, and then Bill Gates comes by and hits you with a bat. That all happened. That's the probability of that happening. You've never met Bill Gates in your life. For some reason, he goes crazy that day and hits, all 4 of those happen on the same. Maybe he got bit by the dog too, but who knows? But all those things happen on the same day. Can't happen. So why did it happen a few times in 2008? So either 2008 didn't happen, or our risks are not normally distributed. Which do you think might be the latter? Do you think 2008 didn't happen? You just dreamed about it. Like 2008 didn't happen. No one actually walked on the moon. All these insights, conspiracies that are going out. The world is flat. So no way it could have happened. All right. So His risk tolerance is 1%. So you know it's a 2.33 standard deviation event. We call it 2.3 sigma event. His risk budget is 20%. So the valued risk, we're going to take the mean minus 2.33. That's the number of standard deviations that equates with a 1% event. All right. If your bank is saying it's 99% is their risk tolerance, they mean 1%. They're just backwards. And then what's the 15%? Anybody remember what that number was? The standard deviation we expect for the stock market. And when we do that, we get negative 0.2695. You can do the math. R, it's a VAR of 26.95%. We don't say it's a VAR of negative 26%. It's a VAR of 26.95%. So can he put 100% of his money in the stock market? What was his budget? Budget was 20%. How much is his VAR? He can't do that. He's going to have to add some bonds to that portfolio to try to get that risk down. Now, what if he does that? He puts 30% in bonds, and then 2022 happens and he loses 22% because bonds and stocks are both down. Does that mean the math is wrong? No, it just means something happened that happens less than 1% of the time. So just because he has a loss bigger than his VAR doesn't mean VAR is wrong. It just means something pretty rare happened. So he only wants to see this 1% of the time. Who knows how old Uncle Todd is? 1%. In the next 100 years, he should see something worse than that once. And he probably is not going to live another 100 years, so maybe he'll be lucky and never see one. Questions on that? Edgar?
For these kind of problems with bar advantages, do you feel like know they can do it or not, or is it more follow up?
Yeah, the questions I'm giving you are pretty straightforward. I give you that. I give you the table so you can find that. So you have to get used to doing that. I give you that. You've got to know this formula. And then all you have to do is compare that number to that number and say whether they passed or failed. That's all you got to do on exam 1. On exam 2, we bring correlation in, which makes it a little bit much more difficult calculation, and the discussion is a little more interesting. But yeah, I'm making it really, really straightforward. Now, where students get messed up on the exam is this is an annual. With an annual analysis, the expected return of 8% is 8%. If I give you daily stuff, what do you think the expected return on a daily scenario is? What do we expect the stock market to make tomorrow? What would be your best guess?
The 70 division is like 4.5%.
Standard deviation is 1.2%. But what's the mean? What do you expect the stock market? If you had a bet on the stock market tomorrow, what would be your best bet? It'd be 0. Because on average, the stock market's up 0.03%. It's, 0 is your best guess for tomorrow. Well, unless you look at the futures today, but still, if you don't have any information. So there are problems where the mean is going to be 0. If I'm giving you daily data, your mean is going to be 0. And some students freak out. What do? You put 0. It's 0. Your mean can be 0, even if your standard deviation is 1.2%. Right. So your banks are doing daily VARs. So their mean that they're comparing to is 0. Any given day, your best bet is 0. Over time, yeah, you expect to have a positive return. So with annual numbers, you have a significant expected return, but with daily, you're probably taking 0 minus that. So he can't do that. He fails. He's over his budget. I'm using the word risk budget, but he's over his risk limits. Probably a better way to think about it. All right, this next one, your boss wants to look at a new portfolio strategy. You run the analysis, determines that it has an expected return. Has an expected standard deviation of 8%, an expected return of 6. I don't know why I switched those two. So your standard deviation is 8%, your risk is 6%, your risk budget is $15,000. Here's the other thing to be careful of. Sometimes we talk about VARs in percents, sometimes in dollars. If you calculate your VAR in percent, but then the budget's in dollars, then you're going to have to convert it to dollars. But that's easy to do. You just multiply it by the size of the portfolio. Portfolio is $225,000. If you have a VAR of 1%, you just multiply that by the 225. So you have to be able to convert back and forth between dollars. So his risk tolerance is 1.3%. All right. So what table? So here's a good practice. His risk tolerance is 1.3%. There isn't 1.3%. It's nowhere in this table. So what are we looking for in the table? 98.7. So do y'all see 98.7? Now, which of those to use? I had a professor at the time. I thought, oh, this is what people do. He made us interpolate the number between those two numbers. If a professor ever asks you to do that, just so that's ridiculous. We're not. We're going like this most of the time, but then every once in a while we go out 8 decimal places. Like there's no reason. You're like, it's somewhere around 10 million. Oh, wait, here's the number. I used to joke at USAA, the poor accountants, they call to get our bad risk and percents, and I would go out like 6 decimal places, and I go, oh, I'm just joking. And then they go, yeah, you're joking, but what was that last number? No, we're not that precise, but yeah, they just like we're stressed out. Just give us the number. All right, so which do you use? My recommendation, just go to the higher number. So what would that be? 2.23. You do the 2.2 and the 3, so 2.23. 2.23 is the number of variations that equates to 1.3%. Are y'all getting comfortable with that? We'll practice it more next week, but you should have done it in your stats classes, but when did y'all have stats? Are y'all like I was in stats? It's like, I'm glad I got this class behind me. I'll never need that again. And then I was like, oh, wow, that was the most important class I took. I wish I could go back and do it again. Unfortunately, they teach stats in the math department. They should teach stats in the finance department because it's a very, very different way we use it. So hopefully you did this in your stats. So the VI at risk is the 6. What is the 6%? Expected return minus 2.33. What is that? Number of standard deviations. Yeah, be careful. The other thing the accountants would do is say, Ron, what was that standard deviation? What do you mean, what is standard deviation? They wanted me to give them the 2.23. That's not the standard deviation. That's the number of standard deviations that equates with the 1.3 risk tolerance. All right, so make it real clear. I know students say, wow, you're so picky. But is it accurate to say 2.23 is the standard deviation? No, that's not accurate at all. It's this number of standard deviations that equates with a 1.3% risk. So be very precise. And the 8% is what? Expected standard deviation. So you do 6% minus that, you get 11.84%. So a value at risk, 11.84. Look at the way I write VAR. I like to be in the habit of writing VAR with my risk tolerance. My VAR 1.3%. So I just want people to know what my VAR is. I get in the habit of doing that. I think it's helpful. So their budgets in dollars, $15,000. So how do we take this 11% and convert it to dollars? We just multiply it by the portfolio size. And we get a value at risk of 26,000. Our budget was 15,000. Can they do this portfolio? No, they can't. It's too much. Now, I probably won't do this to you on the exam, but it's good to be able to go back and forth. If 1.3% is too low of a risk tolerance for this portfolio work, what probability could we accept? So the expected return is 13,500. We're allowed to lose 15,000. So we're starting at 13,500 positive. We're going to $15,000 loss. How far is that distance? It's 28,500. Do y'all see that? You're expecting 13.5, but you're worried about losing 15,000. So you lose the 13.5 and an additional 15,000. You're 28,500. Your standard deviation is 18,000. How did I get that? Because your standard deviation is 8%. and their portfolio is 225,000. So that gives you a standard deviation of 18,000. So 28,500 divided by 18,000 is 1.5 standard deviations. You go to the table, 1.58. It's about 5.71%. What risk tolerance did they have? 1.3%. They have to be comfortable with the 5.71 risk tolerance for this portfolio. Makes sense. They're way off, not even close. Right. I have put this problem on the exam in the past as like an extra credit, so that may be there. Do y'all want extra credit problems, or is that just too much stress?
Yes.
I have students like there's not a class after this, and they'll be here till 3 a.m. if I do that. It's like I know I can get it. If I sit here for another hour, they come to me. But anyway, all right. All right, so I'm going to skip this last part. So let's do a daily one, just so you can see they have a currency portfolio of 500,000 with a daily risk budget. Now, sometimes I say a portfolio has a notional value of X dollars. When I give you the notional value, that doesn't change anything. When you're calculating your VAR, you apply it to the notional value. Remember, the notional value is your risk as if you had that portfolio. Your gain or loss is going to be as if you had that portfolio. You don't actually have that portfolio, but when you're calculating the VAR, you still multiply it. So it doesn't matter if I say this is their portfolio or it's the notional value of the portfolio. It doesn't matter. You use that value to calculate your value at risk. So they have a budget of 20,000. You have a strategy. It has expected return of 0. Why? Because it's daily. Student, what's the expected return on the stock market on a daily basis? Students say 1%, but if you stop and think about it, you make 1% on average a day over 250 days. That's a pretty good return. So that's probably not, that's too high. So you get comfortable 0% is a good estimate for anything. Standard deviation, really low. Why is it so low? Because it's daily. That's actually a pretty high standard deviation for daily, because what was the stock market? 1.2, so 2% is more risky than the stock market. Based on a trailing 60-day analysis, which is what a lot of your banks are doing. That's why their VAR kind of moves up and down with markets. Your risk tolerance is 5%, so how many standard deviations is that? You know that off the top of your head. 1.6, you can go out another decimal if you want to. Can you use that strategy? So you take 0 minus 1. I use 1.65 times 2%. That gives you 3.3%. 500,000 times 3.3 gives you 16,500. Your risk budget was 20,000. Is that okay? You're in compliance. That portfolio would work. Now, one thing to notice with your banks, I can't remember last year how it was. Seemed like last year was a little more stable year, definitely more stable than 2022 and 2020. But Goldman and some of these banks, they brag. So they have a 5% risk tolerance, and they brag they never had a day greater than their value at risk. So their value at risk was say 50 million. So 5% of the time they're expecting to lose more than 50 million. And they said we never lost more than 50 million. That should have been impossible. Because 5% of 200 days, they should have had 10 days where they lost more than 50 million. And they said we didn't lose any, we didn't have any days. There's something wrong with the calculation. Either they had a really, really smooth year or their calculation is too conservative. But what really happens, some years they don't exceed it ever, which doesn't make sense. And then you get a year like 2020 or 2008, and they exceed it 50 times. So obviously there's something strange going with that risk. So your risk manager for AIG, that's kind of a joke, but not anymore. But since they went under in 08, you have a risk tolerance of 0.5%. All right. So someone help me. What am I looking for in the table? 0.5%. So 1% you're looking for 99. 0.5% you're looking for not 5%. 995. All right. 995. Somewhere between these two. So I'd probably go with that. So 2.58. 2.58. Your portfolio has a notional value of 4 billion. Don't freak out, doesn't matter. Your portfolio is 4 billion. The market value of the portfolio may only be $20 million, but it's going to move as if they had $4 billion invested in. We're talking about risk, so that's what you're interested in. All right. Your portfolio has a standard deviation of 3%, so it's a very risky portfolio. You have a risk budget of 100 million, which makes sense because your portfolio is 4 billion. So your value risk getting 0 because this is daily, minus 2.58 times 3%. That's 7.74. You notice I didn't even put the negative sign there. That's 310 million. Does that work for them? That would be way out of bounds. They wouldn't even consider that. You want to ask what risk you want to work through these, you can. Whether I give you as an extra credit or not, you can see. But essentially, when I say what would be acceptable, then you take their risk budget and you plug that in, and then you're looking for the number of variations that equate with the risk budget. And that kind of gives you the sense of what would be acceptable. All right. So we'll have to work some more of these as we get into it. Let's look at the stock market, though. And let's do this with the stock market. So you might ask, is the stock market normally distributed? A lot of people say it's log normally distributed because you can't lose more than 100%. So you can make more than 100, but you can't lose more than 100%. We're doing daily here, so where did it go? All right. So if you do SPX, you gotta be careful on Yahoo Finance. The one that's up here, especially that, you can't use the futures, but even when the market's open, that one is the GSPC. They won't give you historical data on that one. So if you want historical data, you got to use the SPX index, this one here. And how far back do they go? Is 1927 enough data? Any of you are alive in 1927? Probably not. So yeah, take that out. So we're gonna get the daily return of the stock market. We're going to leave the Great Depression in there. That's obviously going to raise our standard deviation some. We're going to leave 2008 in there. That's obviously going to raise the number. So the average, I said 3 basis points. Let's see if that's still accurate. That looks pretty close, doesn't it? 3.06. So the daily average for the S&P 500 is essentially 0. So your best estimate tomorrow, I mean, you could say 3 basis points. That'd be, but you might as well just say 0. Your best guess for tomorrow is 0. The standard deviation is 1.2%, as we've been saying. So the question is, what's the probability some of these things happen? So here the market fell 1.95, 1.65. So how many standard deviations is that? So the mean, I'll use the mean. We don't really need to because we know it's close to the standard deviation. So how far is 1.65 loss on a daily basis when you on average make 3 basis points? You can do that in your head. How far is that? At 2%, 3.7%, how far away are you? You expect to make 3 basis points, but you lost 165. How far away are you? Three minus 1.68%. Y'all see that? How many standard deviations is that? 1.68 divided by that, 1.04. What's the probability of that happening? That makes sense. About 8% of the time, you would expect to lose 1.6. Does 1.65 sound like a crazy day? Would you expect a 1.65 in a year? 8%. How many days are there in a year? 250 as far as market days, maybe. So maybe 20 days, you would see something like that. That seems reasonable, doesn't it? Doesn't seem too crazy. Y'all seeing where we're doing this here? Let's take this somewhere else. Let's try, well, we'll go into the Great Depression. Y'all know what the bigger days in the Great Depression is? We know coming out of the 20s, we had some big days. What about a 4% day? What do you think the probability of that is? Is it less than 1% of the time? Do we have entire years without a 4% day? A lot of years without a 4% day. So it's probably a much less than a 1% event. In fact, we've had years with no 2% days. So let's try it. Let's see if we get the math. What is this 4.1? Someone tell me how I got that number.
It's the spread in your mean and
Your loss. So I expected 3 basis points. I lost 4.07%. So I was 4.1% away. How many standard deviations is that? How did I get that? What is that? 343. So it's, give me the two numbers I divided. Yeah, I divided 410 by 120. 120 is standard deviation, but I'm 4.1 away from the mean. So oops. So that happens 0.03% of the time. So an average year, you would expect 0.08 of these. So a lot of years, you should see a lot of years without a 4 sigma event. Pretty rare event, but you should see one every once in a while. Like, I don't know how many 0.08, maybe in 5 years. Or maybe in 10 years, I guess. Every 10 or 12 years, you should see a 4% day. What if you saw a 4% day 3 times in the same week? Would that be likely? That would be pretty crazy, wouldn't it? All right, y'all tell me if I'll see a bigger day. We're in the 30s, right? We're entering the Great Depression. Good old Hoover. There's a 3.7 day. Another 4% day. That one's probably about the same. What about that day? How often do you see a 12% day? It never happened. It didn't happen. What happened the next day? That day didn't happen either. What about the next day? That day didn't happen either. There's 3 days in a row that they're all impossible. Each one of those is Bill Gates hitting you with the bat after everything else. And that happens 3 days in a row. What's the chance a plane part's going to hit you 3 days in a row? They'd have to be gunning for you. At that point, you'd be a little nervous if someone's coming after you, if they could hit you that accurately. So not going to happen. All of those are impossible. Here, because I went the wrong, yeah, I didn't put the minus, but I should just do abs. So have we had any days bigger than 12%? The Great Depression was really bad early on as we came out of the roaring 30s. You had some bad days, but those were pretty bad days. Where are you going to see the next really big year? Y'all know?
Oh, 2001.
Earlier than that.
Oh, yeah, the black.
Yeah, what year was that? Y'all might see it when we get there. So there it is. So that's got to be the worst day. How often does that happen? And that one's like off the charts. How many standard deviations is that? That's a 17 sigma event. 17 sigma. I don't even know if that could happen in the universe. If there are a billion Earths out there with stock markets, I don't know. You know, how do you do the math? Carl Sagan, billions and billions of millions. I don't know how many you would need, but this could not happen. Not possible. And then look at the next 2 days. The next day was, happens occasionally. The next day happens very infrequently. But again, and even the next day was pretty rare. And the next day, And look at that, a 20% day, 5% day, 5% day, 25, 9, 3, and 8. That's like 7 almost impossible days out of 8. So how did your stats class help you, on those days? Say, hey, no problem, because it couldn't have happened. So you tell your boss, hey, no, you don't worry. I took stats and those days didn't happen. Here's a 6% day. That can happen extremely, very, very, very rarely. So where do you come next? So that's where 2008 comes in, right? In fact, the markets were pretty mild. We had a little bit in the 95, 94 was a little bit bumpy, but 94 was more of a bond market crash. All right, so 2008, y'all remember anything about, you don't remember, but there are some good books on 2008. I haven't brought 2008 into this class because it's just, there's too many things that were going on, but it's mainly a subprime year. So how did the year start? What was the biggest bang to start the year? So you know a little about 2008. So what firm went down first? Stearns crashes and JP Morgan takes them. All right, then we're kind of mellow for a while. Guess what I was doing then? Our CEO had just resigned. We had a new CEO. Our previous CEO had us all in cash. I'm head of equities. Guess what I do? Hey, let's get back into stocks. All right, so I get us back into stocks. About this time, the stock market goes up 9%. And I listen to Dee Dee, and she's talking about how horrible this year is going to be. So I get completely out of stocks. Thank goodness. And then things start unraveling. So you see some pretty bad days there, but not nearly what you're going to see. What's the next big shoe to drop? Lehman, yeah, that's the huge weekend. And then you got Freddie, Fannie, AIG, Washington, it's just all over the place. So September is when you start seeing things start unraveling. There's a pretty bad day there. Someone look up when Lehman went down. It may have been this. Find out what day Lehman went. Maybe it was the 29th. I was on Bloomberg television the weekend after Fannie and Freddie went down. And I know nothing about Freddie and Fannie, and that's what they were, what? The 15th. So it took them a couple of days to, so a pretty big day. Although you had two of them right together there. But yeah, I mean, I knew that was the first question they're going to ask. So I had to learn everything I could about Freddie and Fannie. It was just a terrible time. My premier television shot was talking about stuff I knew nothing about. There's an 11% day. There's a 9% day. Look at some of these weeks, 4%, 3%, 6%, 10% day. How often do 10% days happen? Started selling down a little bit, but you're still getting these crazy days. Look at this week, 6, 6, 6, 6. 4 days in a row is 6% losses. Now 6% is possible, right? Bill Gates will give us a number, but in I can't remember how I did this. 250. How many should you see? Let's say at 100 years. You wouldn't expect to see 1 day in 100 years. We saw 4 days in a row. That sounds like something's going wrong with the statistics. So that was a pretty bad week. There's an 8% day, 2-3% days, and then we're getting back, starting to come back. The market bottomed out around March somewhere, I forget exact date, and then started coming back pretty strongly. There's a 7% day. So 2008, if you're using the statistics you learn in stats, 2008 was like, throw the book away. You had nothing to really help you in 2008 because it was just off the charts. Then what do we come to next? What's the next big volatile year? One that you lived through. And you learned Zoom really well. Like 2020, I don't know if people realize it because the market crashed and came right back so fast. But 2020 has some record volatility, especially for treasuries, but the stock market as well. So I forget what day. I remember going home for spring break and never coming back. So it was around March Madness. Did they have March Madness, or they probably canceled March Madness, didn't they, that year? So look at this, you have a 7%. 7% day is possible. 9%, look at that, 9%, 9%, 12%. So incredible volatility during that day. It's just amazing. So we're using something called VAR that works really well most of those other years. I only showed you like a few of the years, but when it doesn't work, when are you most worried about risk? Is it in 90 through 99? Is it in the 60s? Or is it in 2008, 2020, the Great Depression? You're worried about risk when risk is happening, and that's when that risk doesn't work. So it works well until you need it. That's when I'm worried about risk, is when things are blowing up just dramatically. You see how stable it's been since then. Some pretty tame years. This year's probably been pretty tame. We can look at this year. So far this year, the daily standard deviation's 70 basis points. So this year's been a pretty mild year, hasn't been all that volatile. We've had some years where it's like 0.5%, just incredibly mild years, nothing happens. People are like, you know, there's no news, it's hard to write articles and podcasts because there's just nothing going on, but it's kind of nice. Everything's really relaxed. And then it's followed up by a crazy year. We'll talk more about this. How do you handle this in your career? Because the question I asked, do you think there will be another 2008 in your careers? Anybody think that, or is 2008 so rare it never happen again? Do you think something like 08 will happen in your careers?
Yeah.
So if you do, and you know finance doesn't work, what are you going to do now to get ready for that? We'll have to talk about what can you actually do, or you just say, hey, when that happens, we just all remember what I talked about with the dual. You just say those are going to happen, and then my focus on survival. I'll just survive, and then we'll go through and start over again. Or is there a better solution than that? So, all right, I'll stop it there.